All right, I know it's been a very long time. I'm so sorry, guys, but I was away. I was out of the country for a couple weeks. I was in New York afterwards, and now that I finally have some time, I'm gonna go over what happened with my evals, what happened with my trading plan, what happened with my videos, and also just get into some plans that I have moving forward with my trading, because I'm definitely gonna be making a lot of changes on this journey to becoming profitable, and I'll go over all of that with you guys right now. So this screenshot is from August 20th. I had just secured a green day, and actually the 21st and the 22nd I ended up losing money. I had two red days after this where I lost $240 on each of those days. So I brought my P&L for the month, well, P&L for these total eval accounts down from $2,000. I think I was at $2,080 to $1,600 and I think $17. So after those 2 days, I just stopped trading these accounts, honestly, because I was about to hit my rebill, which means that I had officially spent a month on these eval accounts, and all I had to show for it was $1,600. Of course, I just started trading a few months ago, but in my eyes, that's an L. It shouldn't take you a month to make $1,600. Like, that's ridiculous. It shouldn't take you a month to pass eval accounts. That's ridiculous. Obviously, I had some red days. I had some lapses in judgment, specifically this day, like the 8th, where I was on a full tilt psychology-wise. I just was clicking buy and sell and just doing dumb shit. I lost so much. Well, I only lost $300 because of my risk management, but still, I lost trades that I ultimately shouldn't even have been in, that I shouldn't even have taken. These two trades on the 21st and 22nd were terrible trades. This minus 452 day, that's ridiculous. I shouldn't be losing that much money in one day. And I actually ended up switching my risk management strategy afterwards, specifically so that wouldn't happen again. But still, I mean, all these are losses that fried my accounts, losses that set me back, losses that prevented me from being able to get that 3K goal and prevented me from being able to pass. So moving forward, I'm definitely going to take that into account. I'm going to try to build up more discretion as well and a lot more patience when it comes to the charts, so that way I'm not taking trades that might result in a loss. And I actually have a new model. So if you guys remember, before I was trading reversals, I was trading the unicorn model. Now I'm going to be looking specifically for continuations. And over the last 2 weeks that I haven't had these eval accounts, I've been backtesting, I've been journaling, I've been learning about the continuation model. And I'm actually going to break it down for you guys right after I finish talking about all of this eval stuff, so I can show you guys the new model and also just break down why I want to switch from trading reversals to trading continuations. So yeah, this is the account. Again, I stopped trading these because I was about to have my rebill for the month, and again, I didn't want to spend more than a month on these. I feel like if you're spending a month on evals, you need to step back, look at your losses, look at what's working for you, what's not working for you, and then move forward when you've maybe set a different plan or set different goals, reevaluated the way you trade, and then coming back into my evals when I am ready to trade the evals with my continuation model. I'm going to be risking a lot more money per trade, roughly around like $750 to $1,000 per trade, and I'll be looking to pass them within 2 to 4 trades realistically. So we'll see how that goes. I'm going to be trading minis instead of micros as well, which obviously, as you guys know, makes it harder to take partials because you can't really do that when you're trading minis unless you're trading multiple minis, which is crazy, but we'll see how things go. Obviously, I'm going to be a lot more discretionary with my trading moving forward, and I'm going to break down all of that in literally like 5 seconds. So here we go. All right, so real quick, I'm just going to talk about why I'm switching to continuations as opposed to trading reversals like I previously was. And here's a few reasons why. With continuations, you're trading with the trend instead of trying to trade against it. With my previous model, the unicorn model, I was waiting for setups. I was waiting for a reversal to happen, hoping that it would happen during my macro, which again, I had specific 30-minute intervals throughout the morning that I would look for trades within. And that was 9:45 to 10:15, 10:45 to 11:15, and 11:45 to 12:15. within that model from the person that I learned it from, those would be like the most ideal times to catch reversals, to catch those unicorn trades, to catch the silver bullet, as it's also called in ICT. And for me personally, I feel like that wasn't working. It was very difficult for me because of my job to not only just sit there and watch the charts during those macros. Work was very busy around the second and third macros as well, so it was, again, pretty hard for me to actually just sit on the charts and wait for these things to happen. And because we're also looking for entries on the 1 minute time frame, like, you can look down for 2 minutes, look back up, and boom, you've already missed your model. That happened to me so many times where I would literally miss good trades because I was looking away for like 30 seconds or a minute or whatever, or, you know, obviously a couple minutes probably, but there would be so many times where I would miss the trades because I was, you know, busy or I was working. And personally as well, with my personality style, my trading type, I feel like it's a lot harder for me to just sit there and wait for something to happen. And even more so, knowing that that model might not even appear at all is insanely difficult on my psychology, because it's like, all right, I just spent, you know, hours sitting here waiting and the model didn't even appear, or I could have missed it if I looked away for like 2 minutes. So I personally I hated that aspect of trading the unicorn model. I feel like the continuation model is going to be something that is a lot better for my trading style, and that also goes into point 2. With my level of experience and discretion within the market, trading continuations is going to be a lot easier. I think it's a lot more simple because we're trading towards specific draws and liquidity, and we actually are waiting for confirmation after a retracement in the opposite direction for price to, again, continue towards that draw and liquidity. And I know that probably sounds like gibberish, but I'm going to explain all of that in a second as well. I'm going to draw it out for you guys. But also within the continuation model, there's a much higher win rate if you trade it properly and if you take good setups, because you're trading with the trend. Predicting reversals is extremely difficult because, you know, we could sweep some form of external liquidity or some high probability liquidity, like maybe previous day high, previous day low, whatever. Price might not even react to it. Price might not even, you know, reverse. It might retrace at that level and continue going, in which case, oh, you might have gotten faked out with a unicorn model, or you might have gotten faked out and thought price was going to reverse. You started selling, and boom, it actually went in the opposite direction, or continued to go long, and boom, you just lost your trade. So it's a bit more difficult to, again, catch those reversals than to catch the continuations of a trend. So I feel like this is, again, a model that's a lot more suitable for my level of experience and discretion. Let me actually draw this out for you. So with the unicorn model, ideally we're looking for maybe some accumulation, you know, maybe a manipulation, and then a distribution phase. And ideally, we are looking for longs somewhere right around here, where price displaces after the manipulation, and then we're able to catch this huge distribution leg for, you know, sometimes a 1 to 2, a 1 to 2.5, 1 to 3, whatever. So it's a higher RR, a higher risk to reward ratio, because we're risking X amount and we're potentially making 2X or 3X or sometimes even 4X as profit. So it's a lot higher RR, but the probability of this happening, the probability of you catching this, is not as high. My win rate for the month was about 60%, and obviously I had some days where I wasn't trading that properly. I was also trading outside of that model, so realistically I could have had like maybe a 70% win rate, which honestly is pretty good, but again, for me personally, I just feel like it wasn't working, and I also was not trading that model a lot of times, because it's so hard for me to just sit there and wait for reversals to happen, because you really cannot predict when it's going to happen, at least like in terms of from a time standpoint. And there'd be a lot of times where it would happen outside of macro and I would miss that trade, or it would be a no trade day for me. There'd be a lot of times where price didn't even reverse at all and it just distributed and went in the same direction the entire day. So that was very frustrating. But essentially this is the reversal model that you're looking to catch. Now in the opposite direction, we are looking for continuations. So boom, let's draw another accumulation phase. Let's draw another manipulation. Let's draw a distribution phase. And as price is distributing, and now that we're bullish, it's going to make higher highs and lower highs. As you can see here, these are all retracements. And ideally, with the continuation model, you want this manipulation phase to come right into a point of interest. This could be a 15-minute fair value gap, whatever, for example, I just made that up. But ideally, we're manipulating into a 15-minute fair value gap. We're reversing out of that, and we're heading towards a draw on liquidity. Let me actually move this up. And this draw on liquidity could be maybe an unmitigated gap. Sorry, let me delete all this. Let's say our draw on liquidity for the day is an unfilled 4-hour gap, which we know is a strong draw on liquidity because the higher time frame gaps are very, very likely to get mitigated, to get rebalanced, and to be honestly strong draws on liquidity. So with this continuation model, again, we're accumulating over here. We want to manipulate into a point of interest or a PD array. That could be a fair value gap or an order block, whatever it is. And then we want to distribute to a draw on liquidity. And ideally, during this distribution phase, there's going to be retracements, there's going to be pullbacks because price has to come down first before it can go back higher. It has to get momentum for it to go back up. And ideally, what we want to do is catch maybe the second to last or the last retracement back to our draw on liquidity, in which case we'll catch this and maybe go for like a 1-to-1 or a 1-to-1.5, 1-to-2, whatever it is. But I personally am probably just going to do like 1-to-1s maybe, or 1-to-1.5. So let's actually do 1-to-1.5. That's close enough. And again, ideally, we're already getting confirmation that price is going in this direction. It's heading towards this draw on liquidity. So ideally, all we want to do is wait for a retracement, zoom down into the lower time frames, like maybe the 5-minute, the 15, find a fair value gap or order block that is getting respected, and then trade when price confirms that it's going to be bullish towards our draw on liquidity again, coming out of that. So actually, realistically, my entry is probably going to be up here. Maybe even up here after we've displaced above this previous high. So realistically, again, it might be, smaller RRs. And I'm 100% okay with that because I feel like it's going to be easier with having that level of confirmation where we're clearly going towards our draw on liquidity. We're clearly bullish after displacing this previous high. We have our target. We have PD arrays that are getting respected, like maybe fair value gaps all the way over here. Like if you can clearly see that all of these are bullish fair value gaps that are getting respected, we're clearly in an uptrend. Okay. So it's a lot easier to, again, trade with this trend. Higher high, higher low, higher high, higher low, higher high, higher low. We're going to make a higher high because there is a unfilled draw on liquidity right up here. And again, that could be a higher time frame gap. It could be, all right, most times it's going to be a high time frame gap though, but it could be any PD array that's up here that hasn't been mitigated, that we're clearly drawing towards, that price is clearly trending towards. And then ideally you want to catch the last or second to last leg on this way up with confirmation. So I'm going to break this down in the charts as well, show you guys some real examples, but I feel like this is a lot of an easier move to catch based on my level of discretion and my level of experience within the markets. So for the last 2 weeks, I've been backtesting that, I've been learning that, and I've been studying that. I have a 90% win rate right now on TradeZella backtesting this model. I'm obviously going to continue to do that. I've been trying to do 1 week's worth of backtesting every single night. So 1 week's worth of price action, but I'm just going to continue to do that and just keep cooking with the model and keep cooking with the backtesting to gain more conviction, to gain more familiarity with the model, and again, just build up more discretion. Because discretion isn't just about knowing when to take trades, it's also about knowing when to not take trades. Because that's what really turns you profitable. Knowing what types of losses to avoid is what keeps you profitable. It's what keeps your account. It's what keeps you, in the game longer. It's what keeps you consistent. And that's definitely going to be like one of the biggest goals for me, especially with this model. So I'm going to look for some examples right now on the charts for you guys, and then I will hop into that and break those down for you. All right, so daily time frame, let's actually go down to the 4 hour, because ideally I want to be looking at 4 hour gaps. My main time frames for this model are going to be, well, the 4 hour. All right, actually, let me do it like this. Draws and liquidity are going to be 4 hour. Actually, let me also do 1 hour. 4 hour and 1 hour unfilled gaps. Boom. For entries, if it's a 4 hour gap, I want to do a 15-minute retracement. Well, retracement into a 15-minute fair value gap. Sorry. Retracement into a 15-minute fair value gap. Or if it's a 1 hour gap, retracement into a 5-minute fair value gap. Then, actually let me do this. This is confirmation. Then entries would be either the 1 or 5-minute time frame. Okay. And I'll show you, I'm going to try to find some good examples of both of these for the entries so I can really show you guys like how it gets down. But this is pretty much what I'm going to be looking for. And again, this is random price action. Like I haven't been trading since like August 25th. I have mostly been backtesting, so I have no idea what the fuck happened like most of these days. Like from here on, I have no idea what happened. So I'm just going to be literally looking for the model to appear. I'm going to look for 4 hour fair value gaps to get respected. Oh, this is actually maybe a perfect example. Like this whole sequence right here is actually maybe perfectly what I'm looking for. So let's zoom into this. All right. So we have this 4 hour fair value gap. Let me turn my magnet on. 4 hour fair value gap right over here. Ta-da. And as you can see, we literally form this fair value gap. We wick into it and we come back out. And as you can see, we're also already inside of a fair value gap. But we have this point up here at the top of these fair value gaps. So this is going to be our external buy side liquidity that we're most likely going to look to target after tapping into this fair value gap. So when you tap into a bullish gap and you're respecting it, you are looking to catapult out of this area and continue upwards to make a higher high. So we come down into here. We're at the 23.3 range, $23,300, and our draw on liquidity is $23,386. So that's 80 points where I can I can find a move somewhere in there within this 4 hour candle, or even preferably within this 4 hour candle right here, and look for a trade to this draw on liquidity, which is this buy side liquidity. This is definitely outside of my macro though, as it's obviously 10 and 2 a.m. so results may vary. But because this is a 4 hour gap that we just tapped into, let me actually draw this little circle here so I know exactly where I am. Let's scale down to the 15-minute time frame and I can find that. Okay, over here. All right, and on the 15-minute time frame, what do we have? Okay, so this is literally exactly what I drew for you guys. This is exactly what I drew for you guys. We have, let me get rid of that. We have our accumulation. All this bullshit is accumulation right here. All this untradeable bullshit. We literally have a manipulation right over here. This is all manipulation. And then what are we looking for afterwards? distribution to the upside. So let me delete these so we can see it a little better. But we tap into this fair value gap, and what we're looking for is displacement in the opposite direction to our draw on liquidity. So we have, all right, this might not have been the best example because the draw on liquidity was pretty close. So let's actually do this. Let's go back to the 4 hour. All right, thank you. Where the fuck is it? All right, let's actually do this then. Draw on liquidity is gonna be this point at the top of this fair. Oh, boom, another unmitigated. Oh, no, this is perfect. Sorry guys, I shouldn't have targeted that. This is perfect because this is literally an unfilled fair value gap waiting to get tapped into. Okay, so now let's go back down to the 15-minute time frame. Sorry, so sorry. So again, we have our accumulation over here. We manipulate downwards, and we have another manipulation leg. So we ideally want to see 2 peaks on our manipulation leg. We come back up, displacing outside of this manipulation area, and that gives us confirmation that price is headed in the opposite direction and that we are clearly going towards a draw on liquidity. So boom, we're coming out of here on the 15-minute time frame. We displace with this primary candle. So we tap into this fair value gap right here, this 15-minute fair value gap. We're respecting it. We're not closing below consequent encroachment. Let me delete this circle. Sorry guys. And this fair value gap also aligns with the bullish fair value gap on the 4 hour time frame. So we're clearly in 2 areas where we want to go up because again, we're in 2 bullish fair value gaps. We're respecting consequent encroachment of the 15-minute time frame fair value gap. We come up, we respect yet another 15-minute fair value gap. Literally consequent encroachment is getting respected. We're closing above this. We might wick below it and outside of it, but we're closing above consequent encroachment of these gaps with every single candle. Now the next candle, which ideally I would want to catch an entry on, is maybe this 15-minute fair value gap. Oh, and all these should be gray. I'm sorry about that. My fair value gaps are gray. But like I said, we have this unfilled fair value gap over here on the 4 hour time frame. So this is clearly our draw on liquidity, this red line up here, and we're clearly trending towards it. We're respecting bullish PD arrays. These bullish fair value gaps on the 15-minute time frame are getting respected on the way to our 4 hour draw on liquidity, and we're ideally going to be looking for the last one. So what I would personally do is maybe enter off of this one. We've already respected 1, 2 fair value gaps. Why would the third one get disrespected, especially this close to the gap? Most times it's not going to. There's no reason for it to get disrespected. Yeah, we might have this, this fair value gap over here, but realistically, we're not expecting this to get, respected at all because it's so close to our draw. We're honestly expecting this to inverse. So we have this 5-minute fair value gap that's getting respected. What I'm going to do is now scale down to the 1-minute time frame and let me zoom into this. So actually, I don't even know if it's gonna let me go that far. I might have to go to replay testing mode for that. Not gonna lie. Oh wow, I found it. All right, so we tap into this fair value gap, and what I would be looking for once we tap into it is, I believe it's right over here where we tap into it, and yeah, we sweep this liquidity. Ideally, what I'm looking for is the first sign of like bearish PD arrays getting disrespected. Okay, so on this manipulation leg where we come up, we come down, we retrace, and we make a lower low. Oops. Let me put that up here. So we're clearly making lower lows and lower highs on this way down. The second we disrespect this bearish price action and come up. And the second we see like a sign of maybe a bearish PD array getting disrespected, I'm going to be looking to enter and target my draw on liquidity. So for example, this bearish PD array, this bearish for value gap, gets inversed right around here. The second this candle closes, I could be looking for an entry for longs right there with a 1-to-1. I'm going to put my stop below whatever PD array we're trading out of. So we're trading out of this 15-minute fair value gap right here. So my stop would go below it. And this is very valid. I mean, it's only a 31-point stop. And I would target 31 points to the upside or more. At least 31, so it can be a 1-to-1. But I'm going to target my draw on liquidity. So when I put my stop up there, that's a 1-to-1.25. And obviously, like I said, because it's overnight, price action is going to be a lot more like sluggish. It's going to be a lot slower. But realistically, if I was to enter off of the close of this inverse fair value gap, I'm getting 0 drawdown in this example. And also, once we close below or close above, let me turn my magnet off. Once we close above a protected high or protected low, if we're trading bearish, my stop goes to break even. So it's now a risk-free trade for me. And sometimes that can lead to you getting stopped out. So ideally, I'd want to do either this one, because it's a bit closer to the 50% range for my of my TP. Yeah, it's right around near that equilibrium range of my TP. So I'd probably do this high. Once we close above that high, I would be looking to, again, reduce my risk and bring my TP down to break even. And I'm also just gonna bring this down so I can show you guys like an example. So again, with my stop right there, say I'm trading 1 mini. My stop is right over here. Stop loss comes down here, 124 ticks. Oh, I forgot I have it on ticks instead of money. Let me change that for you guys. Ticks, money. Okay, so it's $620 that I'd be risking to make 780. Yeah, that's cool, but in this example, I would probably trade maybe 15. So I can risk just around $1,000 to make $1,170. With this type of trading, yeah, your RR is going to be a lot lower. Like for example, this is a 1-to-1.26, which with the unicorn is pretty much unacceptable. With the unicorn, we're looking for at least a 1-to-1.8, and most times 1-to-2. This is a 1-to-1.25, and honestly, I feel like this is a very safe trade. This is a very good trade. This is a trade that I would definitely take because we're nearing our draw on liquidity. We're getting confirmation that we're trading bullish out of this bullish for value gap that we're also respecting the consequent encroachment of on the 15-minute time frame. We also inversed the 15-minute time frame fair value gap from over here that I was looking at. So we just inversed this gap. I would feel very, very confident about trading at least 1.5 minis, 15 micros on this. And again, targeting 40 points to the upside for our draw on liquidity. And as you can see, I would have hit that trade in, you know, a few hours. It would have taken a few hours because it's nighttime. Like price action is super, super slow. But realistically, that's a trade that I'm going to take time and time again with this model. That's a trade I would 100% take time and time again with this model. So, let me get back to that. But yeah, that's a perfect example. So we're trading in between two 4-hour gaps. We're scaling down to the 15-minute time frame to look for a 15-minute fair value gap that's getting respected. And as we're trading out of that 15-minute fair value gap, I'm looking for an entry on the 1 minute where bearish price action is getting disrespected, so I can know that we're trading bullish. And the second we do, I enter off of this close of the inverse fair value gap, and boom, 39 points. I'm going to find another example right now for you guys. And again, this is price action that I literally have no idea about. So I'm literally just finding these random examples right now. Let's look for another 4-hour time frame for value gap that's getting respected, preferably within like the last couple of weeks. I think I just did this one, right? September 2nd and 3rd. Yes, I did this one. Let's do. Damn, not many fair value gaps. That's pretty fun. Actually, let me look at this one because we actually made more. Oh no, I think I traded. Oh no, I'm so cooked. This is my TP. Let's do. Oh, this might be a good example right here. So let's do this one. We have this fair value gap right over here on the 4-hour time frame. Oh, let me put my magnets on so it can be very precise. Let's do that. All right, so as you can see on this bearish, oh, this is actually perfect because I did a bullish example, now I can do a bearish one. On this bearish fair value gap, we wick into it, and we have a previous low right over here. So ideally, once we tap into this 4-hour fair value gap, if we have signs that we're respecting it, we're clearly heading towards a draw on the opposite end of the spectrum, which would again be this low. So ideally, I'm going to be looking for entries within, these few candles as we near this draw on liquidity. So again, this is a 4-hour fair value gap, so I'm going to scale down to the 15-minute time frame because again, time frames align with each other, and the 4-hour is aligned with the 15-minute, and the 15-minute is aligned with the 1-minute. But I digress. So we tap into this fair value gap very, very briefly. We respect the hell out of it, and we close, a few points below it. Ideally, I'm going to be looking for trades within this range, fair value gaps to get respected, and I can already find one right here. So we have fair value gaps on the way down that didn't even get rebalanced. I'm sure on ES they maybe have got like mitigated or something, or got respected or rebalanced or whatever, but we also have this third one. So we've already had 2 fair value gaps that got respected, and we have a third one, again, on the way to our draw on liquidity. This also is a displacing fair value gap. This is a breakaway fair value gap. And I say that because once we displace below this low, and it also aligns with our fair value gap. Whoa, crazy, right? How price action works. This aligns perfectly with our fair value gap, making this a breakaway fair value gap. We can expect price to not only respect this fair value gap, but for price to also wick into pretty much this line. Okay? So that's why I would ideally look for this fair value gap to maybe get respected. And what happens? It does get respected. Okay? So let's see. This actually might be a trade where I would get stopped out and break even because I can already see we retraced before going back to this fair value gap. But I'm still going to try to at least recap it. So now let me draw this real quick so we can just go down to the 1-minute time frame and I can actually find it. All right, where's my candles? Okay. Oof, I don't know if I can go back that far. Oh, I can. Oh my god. Oh my god, literally the limit for me to go back on the 1-minute time frame is like a few hours before that. That's ridiculous. All right. So again, we're trading out of this 15-minute fair value gap. What I'm looking for is bullish price action to get disrespected. So we're obviously bullish coming into this to tap into this fair value gap. What I'm going to be looking for is displacement to the downside and or bearish price action getting disrespected. And obviously this is also nighttime, which again is outside of my macro, but the model is obviously still going to work. It's just going to take longer to play out. And ideally, if I was to trade this time frame, which I generally would never, these closures where we're disrespecting these fair value gaps, I don't like these inverses. So ideally, I would want to wait for displacement. And what do we get? Displacement right over here. We displace. And we also create a fair value gap at that displacement. Fair value gap gets respected. What I would maybe do is enter off of this fair value gap, heading to the downside. Again, my stop loss is going to be above this fair value gap because that is our fair value gap on the 15-minute time frame. So again, stop wants to be either below or above whatever PD array you're trading out of on the mid time frame. My mid time frame on this chart is the 15-minute time frame for this example. And I'm going to target at least a 1-to-1. Again, this is nighttime. It would take a lot longer to play out. And based on my rules, I would have probably gotten stopped out at break even, because after this leg, getting this close to our TP, I probably would have moved it to break even. I'm not going to lie. And I would have got stopped out right around here once price went back up. But doesn't matter. It still would have hit TP if I didn't move it to break even. And then boom, that's a perfect example of a continuation. And with this, like, this might fuck with your psychology, because you're going to be in a lot of drawdown. You're going to be maybe down like $700, $800 at one point. But realistically, you know where your draw is going to be. You know that this draw is very, very, very likely to get hit. And you know that, you know, on the 15-minute time frame at least, your PD arrays are getting respected. You're clearly in a downtrend. You're trading with the trend. There's going to be some manipulation on the lower time frames, like, you know, these points and all of these points. But at the end of the day, you're trading towards your draw on liquidity. And that's exactly what happens. So let's do another limit order so I can just show you guys. All right, if this shit wants to place, okay. Stop loss again up here, $772, and boom. In this situation, because it's only 26 points, I would probably do two minis or 20 micros so that it can be $1,000 at least. And then boom. Like I said, I'm probably gonna have to sit through some chop, some drawdown, you know, down 850 at one point. But when you're sitting in drawdown, and especially with continuation models or a model where you have a 1-to-1 RR, you can't like stop yourself out early. You got to let it play out. You're either going to lose $1,000 or make $1,000. And again, when you have a clear draw on liquidity, it's very easy for you to be confident in that and sit through those periods of drawdown, because you know that at the end of the day, it's going to go towards your draw on liquidity. We've already made it this far on the downtrend. Like, we literally, you think we came all the way down here for no reason? No, we're going to sweep out some form of external liquidity. We're going to sweep some, you know, some low. We're going to tap into some unmitigated, We're going to tap into some unmitigated gap on the higher time frames, or some point of, again, external liquidity on the higher time frames. Like, we're going there. You just need a way to get there. And by using mid time frames like the 5-minute or the 15-minute, by using confirmation on the 1-minute time frame, you can really just confirm that perfectly. So again, this is a good example of a bearish one. All right, maybe not a good example because price didn't deliver the way it should have, as fast as it should have as well, because it's also nighttime. Like, that trade would have been fucking like 3 hours long, which is ridiculous. But at least a good example of being able to find draw on liquidity and trade towards it. If you guys want, I can go into like backtesting mode on TradeZella and I can trade this model and just kind of show like how it works in real time. And I say real time like in quote unquote with my finger quotes. You guys obviously can't see that, but I say that with like quotation marks because obviously it's not real time. Like, I'm backtesting, but I don't know obviously what's going to happen next. Hindsight is 2020, so I'm obviously able to show you guys these trades that end up playing out, but being able to do it in the live market is way different. Being able to do it while you're backtesting is way different. So I'm probably going to record some backtesting sessions over the next couple of days while I try to actually just get the model down and really understand it, grind it out, and just become consistent with it. And I've been forward testing as well with this model. I caught a banger today on my demo account during market open with data lows, actually, because today's CPI day. With data lows as my draw on liquidity, and I, like I said, hit a banger 1-to-1 RR, but just gonna continue to practice this continuation model and try to build it up so it makes more sense to me and get a lot more discretion with it, so I know which trades to not take. Like, realistically, like, maybe this is a trade that I don't end up taking, but hey, that's gonna come with discretion. That's gonna come with time in the markets, and we'll really see how things play out. But those are two good examples, and stay tuned. I'm gonna be posting a lot more videos. I'm gonna try to get better, especially with uploading videos now that I'm back, and just really lock in with the model and also my accountability for this channel. So let's get it.